Thank you, and welcome everyone to this Hybrid Summit. I'm really excited to be the keynote speaker. And I'm actually going to use the podium because I have some slides to click and I have some notes, so I'm going to be standing back here. But what I want to talk to you about is why blockchain and crypto assets is really the next big thing, probably the most important thing over the next decade. I think that, along with AI, are really the ways you're going to make money. And it's grounded, I think, in two basic facts. One is there's disruption taking place, but I think more importantly, it's a story about demographics. Now, I think the best way to sort of give you some context is to tell you a little bit about our background. So, as you heard, I'm the co-founder of FundStrat. We started this firm 4 years ago. It's a macroeconomic research firm. But prior to that, I was the chief equity strategist at JP Morgan, a firm I worked at since 1999. And then before that, I was a tech analyst covering the wireless sector, starting in 1993 and working at firms like Kidder Peabody and Salomon Brothers. So I have 26 years of both technology and macro experience. And the reason that's important is that when you look at the money management world today, typically the average portfolio manager has only managed money for 8 years. So we provide the backdrop for our clients, and we've been very grateful. Our clients have recognized us. In fact, I was ranked 1, 2, or 3 an institutional investor from 1998 all the way through 2014, so for 15 consecutive years. Now, if I had to explain why I think our clients like our work, it really comes down to two things. We're known as a firm that does analysis, not opinions. So our work is really facts-based or evidence-based research. But the second is that we've helped our clients over the years find opportunities that you can see a mile away. And I think the best context before diving into this presentation is talk about my early years as a wireless analyst. I started covering wireless in 1993. Now, everybody here probably has a cell phone, but in 1993, there were only 34 million cell phones in the world. Okay, today there's 4.6 billion, so more than 100 times more today. But in 1993, there were only 30 million cell phones. I'm a 23-year-old analyst, and I was trying to explain to my clients how exciting wireless was, that it was going to be one of the biggest things that they've ever seen. And my clients who are typically 40 or 50, used to dismiss what we said because they're like, look, here's a kid telling us that cell phones are going to be huge, but our clients thought cell phones were yuppie toys, expensive, they weren't very secure, and they didn't think you'd actually see much growth. So what I learned back then was that technology and disruption really have to be understood through the eyes of a young person. Now, that gave me a huge advantage in 1993 because we made our clients a lot of money, and it was very easy because I could see the importance of wireless. So let's talk about how demographics and disruption play a role in blockchain. Now, before I go into that, I want to just give you some comments in the near term about crypto. So I want to have a few slides here. The first is, at the start of this year, I think crypto had some headwinds. We had regulatory risk, on-chain volumes were weakening, we had crypto ads banned, we had banks cutting off crypto access, there was a parabolic move in crypto, so I think we've, as a consequence, gone through a bear market. But now I think the probabilities have really shifted, that technicals have improved, Bitcoin's valuation has really come in line, and I think sentiment has improved. So I think this is a great time to be talking about crypto assets and the opportunity. And I want to just fly through a few more slides here. The first is this one. I think it's important to remember that crypto assets require you to be a patient investor. What we're highlighting here is that since 2013, all of the gains in Bitcoin take place 10 days every year. So out of the 365 days you could be doing anything with Bitcoin, if you don't own the 10 best days, okay, so if we exclude them, you've lost 25% a year. So the message here is try to resist the urge to trade crypto because, again, all of the gains occur within 10 days. Now, the second chart I just want to highlight for you relates to the altcoins, and that means everything but Bitcoin. Altcoins follow their own cycle. This is the percentage of altcoins that are tripling, and as you can see, that number peaked in January. Now, we actually advised our clients on January 25th that an altcoin bear market was starting, so it was 1 week after the top, and we've continued to advise them that we're in a period of purgatory, and that should end sometime in mid-August to mid-September. So I think within the next month or so, I think altcoins are going to start working. So again, the message we have just in terms of the market near term is you got to remember to hodl. And the second is that altcoins follow a cycle, but we think it's starting soon. But let me go through disruption and demographics, and if I have time, I want to cover why Wall Street cares. Okay, so the first point to remember, and this is a quote from Jimmy Song, is that decentralization is attractive because there's no single point of failure. And now, why does that matter today? It's because the banking industry and financial transactions are highly concentrated. Let me give you some sense for that. Today in the US, the 5 biggest banks control half of all assets. Outside the US, it's even worse. Finland, Norway, New Zealand, South Africa, 3 banks control anywhere from 80% to 85% of the market. The financial industry is controlled by a handful of giants. Now, every time these giants make a mistake on your account, or you have criminal activity in your account, look at what happens. This is from a survey, but whenever there's criminal activity in someone's bank account, 60% of the time, an American has to borrow money. So these banks control a lot of assets, and if you've got a problem with your bank account, you've got to borrow money from somebody. So clearly banks are not taking advantage of their concentration to make life easier, they're making it harder for you. And in fact, in the last 50 years, this is showing you the percentage of GDP that's going to the banking industry. It's grown from 3% in 1970 to over 6% today. So as the industry's concentrated, they make even more money. And that's despite the fact that interest rates have fallen. So what does this mean? Well, today, the financial sector is generating roughly $5 trillion a year in profits. That is beyond owner's rent. In 10 years, this is going to be close to $8 trillion. This is the single biggest opportunity for the technology sector to disrupt. So we think that's really the big opportunity. But now let's talk about demographics. See, what people fail to appreciate is that everything that we've seen, whether it's mainframes or mobile phones, they were always grounded in a generational change. The generation in charge today are millennials. It's a term that refers to anyone born between 1981 and 2000. And I'd say most people in blockchain today are really falling into that category. But here's what you have to keep in mind. There's 96 million millennials in America. It's the largest single generation ever born, 20% larger than the baby boomers. Now, why does that matter? Well, on this slide, I'm just highlighting that every generation has a different imprint. In the boomers, women entered the workforce. We had PCs. We had mobile phones develop. In Generation X, which is my generation, we had email, we had e-commerce, digital cellular service, Google, and of course now it's the turn for the millennials to make their imprint. One of the things that's very important to keep in mind if you're over the age of 37, because the oldest millennial is only 37, is that you have to look at technology disruption not through your eyes, but the eyes of a young person. And what I've done here is I've shown you what the average millennial looks like today. So the average millennial is 26 and a half, which means Justin Bieber, because he's about 26 and a half. But Justin Bieber was 26 and a half, just like Tom Hanks was 26 and a half in 1980. So what you have to remember is, if you're a boomer, you have to think back to when Bosom Buddies was on TV. And why does that matter? Well, the boomers were, at that time, the biggest generation that ever existed, and these are companies that were started by baby boomers. So Oracle, Apple, Cisco, Bloomberg, Costco, Home Depot. Of course, these are household names today. These were founded when the CEO was less than 40 years old. Bloomberg started Bloomberg when he was mid-30s. Even companies like FANG, Jeff Bezos started Amazon when he was 33. So again, you have to remember, in 30 years, we've seen these transformational companies started by the equivalent of a millennial. Okay, well, let's think about how millennials are different. The first thing that is very evident is millennials do not trust banks. This is a Facebook survey. 92% of millennials don't trust banks. Here's a survey from First Data. 71% of millennials would rather go to the dentist than listen to what the banks say, and a third believe banks won't even, in 5 years, they won't even need a bank. Okay, so we know now the financial sector makes extraordinary profits, and millennials don't want to have anything to do with the banks. Okay, so I'm going to skip a couple slides. Why do we care what millennials think? This is showing you income share by generation in America. Within 10 years, millennials will control the largest wallet in America. In other words, in America, the single most important generation that's going to control all spending and financial decisions is the millennial generation. In fact, First Data has their own forecast. This is from First Data. They believe that by 2020, millennials will control $7 trillion of assets. Now, I think this might actually be the most important chart in the entire presentation, because let's say that millennials put 10% of that, this is just in America, into crypto. Okay, so they allocate $700 billion of their $7 trillion into crypto. Historically, for every dollar that goes into crypto, you see a 20 to 25x change in the price of the crypto market. This implies that a 10% allocation by the millennials would make the crypto market worth roughly $14 trillion, okay? And that's just the United States. Now, if you don't think generations affect markets, look at how the silent generation transformed gold. The silent generation were the children of the Great Depression, and the chart at the bottom shows the number of silent generation entering the prime income years. As soon as they started generating prime income and gold became detached from the dollar, that was the only time gold ever made a 15x move, and it was all because of a single generation. This is the baby boomers. We know the boomers love the stock market. Well, the greatest bull market in US history was 1982 to 99. It coincided with baby boomers entering their prime income years, starting in 82, peaked in 99. Is it a coincidence that the stock market bubble occurred when the boomers were entering their prime income years? I think it's the same story. It's demographics. And that takes us to the crypto market. Millennials are just entering their prime income years today. There's only roughly 2 million millennials over the age of 37. Notice how Bitcoin began to really move parabolically as the millennials entered the prime income years. Well, that's not going to peak until 2028, 2029. We have more than 10 years of rising prices for crypto assets. Okay, but it's actually not just a US story. It's actually a global story. There's 2.5 billion millennials globally. That's 43% of the adult population. Okay, so just think about that. There's 2.5 billion people that are going to be making a decision about how they bank. And you might say, well, how's that going to affect the crypto market? Well, today there's roughly 50 million active wallets out there. That's our estimate. But let's say that 10% of global millennials have a crypto wallet. I'm sorry, 20%. That's roughly 500 million wallets, okay? That's a 10x increase from today. Now, crypto follows what we call social network value, that if it's called Metcalfe's law, that if you double the number of wallets, the value of the market more than doubles. It actually goes up by 4x. So if we're talking about a 10-fold increase in the number of wallets, it's probably closer to a 100-fold increase in the value of the crypto market. So again, the global millennials are going to be driving this. Now you can see this is from Forex bonuses. The top 10 countries that have become the most digital in terms of money, it's the US, but it's a lot of Asian countries. It's China, Russia, Japan, Australia, Canada. Is it no surprise that these are the biggest blockchain markets? And in fact, and Apollo mentioned this in his remarks, Southeast Asia is the epicenter of crypto, because take a look at this. If you were to say, where are the 2.5 billion millennials, you know, 1 billion of them are in India and China. Another 100 million are in Indonesia. The US only has 90 million out of the roughly 2.5 billion millennials. It's really an Asian phenomenon. And what's different compared to past cycles is that millennials are expected to live a lot longer. In 1980, when a boomer was 25, he was only expected to live to 49, and globally, roughly to age 45. I'm sorry, 45 years left to live. These are remaining years of life. Today, a millennial is expected to live more than 10% longer than the boomer generation. So their impact is going to be a lot longer. Now, I want to finish up, and I'm going to fly through some of this because I don't want to take up too much time. But I think you have to remember, this is already happening. Wall Street is noticing this. You know, Binance earned $1 billion of profit. They're expected to earn $1 billion this year. To put that in context, that would rank them as the 4th most profitable exchange in the world. Only CME, ICE, and the Hong Kong Exchange make more money. Binance is a giant. Take a look at Bitmain. It's valued at $12 billion. It's an amazing company. It would rank as the 8th largest financial company in the world outside of banks. Again, a giant. And of course, CFA Institute is adding crypto to its curriculum. So again, it's not a fad. And I actually want to conclude with some charts here that talk about diversification. See, Wall Street likes diversification. They like to get people to own assets that aren't correlated. And this is the correlation at the top of Bitcoin to other assets. So Bitcoin's correlation to the S&P is only 16%. To bonds, it's actually negative. It has no correlation to gold. Crypto is one of the biggest, most highest, percentage generating assets with no correlation to any other market. And we just highlight here, if you had put your money into the stock market 60-40, bonds, equity, that'd be the bottom chart there for the last 3 years. And if you put 10% of your money into crypto and you rebalanced it every month, so you didn't hold it, but you actually sold every time it made a lot of money, that's the top blue chart. You would have actually nearly tripled your return just putting 10% of your money into crypto and rebalancing, and yet your volatility would actually not have changed much. So the point is, again, crypto is really a multi-decade story. It's grounded in disruption and in demographics, but it's something that Wall Street's going to care about. So I think you have an exciting 2 days to find the big opportunities. Thank you very much.